Okay, so here we are again with another really straightforward and common sense kind of technique for analysis, for financial analysis, which is technically called cost volume profit analysis, but it's a lot of people find it easier to think about it in terms of break even. This basically tells you, it's a way of thinking about how much you need to sell in order to cover your costs, how much you need to sell in order to cover your costs when your prices change, how much you need to sell in order to attain a certain level of profit. And so it's a really, really widely used tool. This is chapter 7 in your book, which is module 5, and here we go. Okay, so cost volume profit analysis, as the slide says, it looks at how 3 factors affect a company's profit, and those 3 factors are costs and sales volume and price. And so let's just take a second and put together a little equation for profit, right? So profit equals sales volume, right? Times price, so it's how many you sold times the price that you sell it for, minus cost, right? So, there's more to it than that, but it's at its most basic level, right? We have an equation that equates profit to sales volume and price, and then subtracting the cost, and that gives you your profit, right? We know this. And as I mentioned on the first slide, one of the most important benchmarks that companies try to calculate is the break-even point. So break-even is, how much do I need to sell in order to cover my costs, or the break-even is the point where profit is 0, right? So if profit is 0, so break-even means profit is 0. Profit is 0. And what that means then is, and we'll see this on upcoming slides, but if we think about a profit of 0, and you take, I'll make it blue, and you take this piece, right, and bring it over to this side of the equation, then your break-even point, gives you the level where the sales volume times the price, or the revenues, right? This is revenues. Are equal to your costs. So that's basically all there is to break even, but we are going to go on and on and on about it for another 15 slides in this first section. So as I said, the break-even point is the point where total revenue equals total cost. So that's 0 profit. And also you can think about it, right, a different way. So these are different ways of saying the same thing. So total revenue equals total costs, or the point at which the contribution margin is equal to the fixed costs. Remember, contribution margin is revenues minus variable costs. Right, so when your revenues minus your variable costs equal your fixed costs, then net income, which is profit, equals 0, right? And the thing to keep in mind is that, and I saw this all the time in my world as a small business consultant, new companies don't make money initially, and so the point where they actually break even is a big deal. It's a big deal for these new companies and startups. So in a later video, I'll show you how to set these things up in Excel, and of course using Excel makes all these questions very easy to solve. How many units do we need to sell to break even, right? So that's one thing that we can just calculate for. What happens if we reduce our fixed cost to the number of units that we need to sell to break even? And what happens if we increase our price? What happens to our profit if we increase our price? Does an increase in price lead to an increase in profit? Not necessarily, right? Because it depends on how much the sales will drop if your price goes up. Likewise, you might be able to increase your profit by decreasing price. Remember, from economics, that's a question of elasticity. Right? How much the demand changes due to a change of price. It's a very, very important economic concept that shows up here in managerial accounting, and as I keep saying, that's because managerial accounting is really managerial economics. Okay, there's 4 different types of analysis we're going to do in this next series of slides in the first video. We are going to review the idea of a contribution margin income statement. We are going to calculate the break-even point in units. We are going to calculate the contribution margin ratio and the variable cost ratio. And then we are going to calculate the break-even point in sales dollars. These are all very, very straightforward calculations. Okay, some conceptual background here, right? And now we're getting into the difference between economics and accounting, as I keep saying, right? In accounting, we use the word expense. In cost volume profit analysis, however, we are always using the word cost. What we have to assume here is that all units that are produced are sold. Right, so this is not necessarily a realistic assumption, but in order to do this analysis, that's what we're doing. And so our operating income is going to be equal to total revenue minus total expense, as always, and our expenses are our costs, right? But the thing is that on our regular financial accounting income statement from financial accounting, our expenses are classified according to function, right? So we have manufacturing functions, selling functions, and administrative functions, right? But the thing is that for cost volume profit, we have to try to suss out which of those costs are fixed and which of those costs are variable. It's absolutely essential to do that. And that's why I had you go through that section where I had you calculate, the variable cost, estimate the variable component of mixed costs, etc., right? Because you have to be able to do that in order to do cost volume profit analysis. So to review, we know and we remember that variable costs are costs that increase, that are directly related to the number of units being sold, including all these items, direct materials, labor, variable overhead, variable selling expenses, things like commission, etc., right? Whereas fixed costs would be the fixed overhead and fixed selling administrative, and that would be salaries and other things like that, right? So you remember this from a previous module. So really important concept, you have to go and change out the income statement from a normal financial accounting income statement into a contribution margin income statement. So here's a strange little example of a contribution margin income statement. We have our sales here, right, and then our total variable cost here, and in the total variable cost go, direct materials, direct labor, variable overhead, and variable selling administrative expenses. So those all go into the variable cost, right? You subtract the variable cost from sales, and that gives you your contribution margin. And then we have fixed costs, which are made up of fixed overhead and fixed selling and expenses. And if you subtract those from your contribution margin, that gives you your operating income or profit, right? Okay, here is an example of how to prepare a contribution margin income statement. We're selling 1,000 mowers at $400 each. Our direct materials and direct labor are $180 and $100. Our variable overhead is $25 per mower, and total fixed overhead is $15,000. And for some reason, they give you some of the other variable expenses separately, and then the fixed selling and administrative is $30,000. So this is the beginning of our little example here. And so we are going to need to calculate the total variable expense per unit, the total fixed expense for the year, calculate the total unit contribution margin. Right. So one of the important things in this topic is keeping it straight in your head whether you're being asked for unit break even, unit contribution margin, etc., or total. Right, so you need to read these questions carefully. And then we want to prepare a contribution margin income statement. So this is easy. So the first thing is we calculate the variable expense per unit. It was $180 for materials, $100 for labor, $25 I believe it was for variable overhead, and $20 for variable selling expenses, and that adds up to $325 per unit. And then our total fixed expenses, we were given the $15,000 in factory overhead and $30,000 in fixed, whichever it was. I can't remember the specifics, but that gives us $45,000 total in fixed expenses. And so here is our contribution income statement, right? We've got $400,000 in revenue, which is $400 in sales times 1,000 mowers. Our total variable expenses were $325. We also had 1,000 mowers, so that gives us $325,000 in variable expenses, giving us a total contribution margin of $75. Subtract out our fixed expenses of $45, and that gives us operating income of $30,000. Also, right, we have a per unit contribution margin of 400 minus 325 gives us a per unit contribution margin of $75. And so that is how you develop a contribution margin income statement. In the next couple of videos, we're going to talk about how to actually calculate your break-even points.